A DPP legislator is urging the government to halt implementation of a new tax revision that aimed to boost revenues by taxing higher earners. Wu Ping-jui argues that the change in question, a halving of the tax credit rate for dividend income, would discourage investment by businesses.
A legal amendment drafted by the Ministry of Finance and passed earlier this year had several implications. It encourages businesses to distribute earnings retained from 1998 to 2013, because for future distribution, shareholders will only be able to receive a half tax credit on dividend income. According to Legislator Wu Ping-jui, this will discourage corporate investment.
A major reason why enterprises retain earnings is to make long-term investment. Many retain earnings to invest in fixed assets. If you tell them to convert these retained earnings into cash within 1 year, then distribute the proceeds to shareholders, then you are forcing them to sell assets cheaply.
According to the Income Tax Act, corporate earnings from after 1998 are subject to a 17% business income tax, and retained earnings are subject to an additional 10% tax. Shareholders can deduct this additional tax from their individual income tax. But the new tax reform package, set to take effect, calls for taxes to also be assessed on retained earnings. Corporations are against the change, while a professor at National Taipei University of Business is in favor of keeping it.
The amendment passed in May. Amending it now could be seen as an example of fluctuating policy. Drafting of laws and amendments should be more circumspect. Otherwise, there will be a backlash.
The ministry planned to have the deduction in order to boost revenues.